Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Well, it's July 4th weekend. We're halfway through the year. We're almost on the other side. So in today's show, we're going to go through an update on U.S. completions. What does that mean going forward? Then we're going to give whatever OPEC update we can, because the meeting is still going on. There's a lot of pushback going back and forth, and we'll break that down into different pieces. And then we're going to look at the jobs report. What does that mean, and what do we think happens going forward now that we've had a decent jobs number, and why was it good, why was it bad, and we'll try to shake that out. And then we're going to wrap up with an India-China update, given the fact that India has moved a large contingent of personnel into some contested regions. China has done the same, and this is just becoming a little bit of a friction point as we progress through the summer months. So just to get going with it, we are up 2. So we went from 232 to 234, closing out, beginning Q3 on a strong footing. You know, we only had one increase in the Permian, and then the other in one of the smaller basins. But this is what we've been talking about when we look at what has happened with spreads. What does that mean going forward? So when we look at the spreads right now, a lot of this has been weighted towards oil. A lot of this is crude focused. That remains the case. Genscape is talking about a small build in Cushing, so we're going to have to look at how are things shifting now that we're getting to some of these peak periods on the on summer runs. But what we've been saying is that we were going to close out the month at about 235. So we're right here at about 234. And it's just going to be a slow grind up, just because its labor is 100% the biggest issue right now, is getting people back, getting the right incentives, because we'll talk about this with the jobs data, it's getting costly to bring people back, and OFS will always pass through. Typically when you look at it, labor and fuel and then equipment costs will go to the E&P, and this was some of those big negotiations that were happening in May and June to create the Q3 program, and then what is Q4 going to look like. So these are some of those important periods when we're talking about some of the things that are happening in general. So then when we look at the 3-month, the overall 3-month side of the what has happened, how things have gone through, when we look over the last 3 months, you can see that things have been fairly steady on this point. It's that slow grind, because when you look at how the spreads are positioned, it's more for the oil side. So a lot of the delta or the difference between some of these other years is really on the gas side. So that's where we continue to see injections being on the bullish side. LNG continues to fly off the coast. As you look at thermal prices really pushing things forward. And that's where we continue to see some of that divide. And when we talk about some of these additions, some of them will be in the oil on the oil side in the Bakken. Some of the liquids, just given how strong NGLs have been, how strong naphtha remains in Europe. Some of these shifts are going to support liquids, heavy gas, wet gas, which is going to be a net positive when we look at additions. It's just what is available. And that's where we think that at this point, without much work, you can get to about 250, 255. But to get to kind of that top target that we have of 275, that's going to require not only just more labor, but also more pieces and parts of equipment. So then when we look at just over the last 2 years on the year-over-year side, you can see that things have obviously gotten better from where they were in 2020, but we're continuing to progress and get back to some more of that normalcy. But just given what we're seeing, the actions that are being taken, this is why we're talking about 11.5, maybe 11.7 million on the exit rate, just because we don't see us getting past that point of 275 spreads, just because we don't need it. When we look at what happened with 13.5 million barrels a day of U.S. production, our local refiners couldn't run with it. There wasn't enough demand in the international world for this type of crude. So it was just really, we oversaturated the market. So we don't need to produce 13 million. I think that right number is, at least at this point, is that the 11.5, 11.7. And that's how I think things are really starting to progress on that level. Now, when we turn, provide some of these quick updates, next week our shows are going to be on Thursday and Friday just because of the holiday weekend. So we will have this updated on Thursday, so then we won't have it on the Frac Spread Show. But this is what we're talking about, when we talked about Singapore pretty much going sideways, where not too much adjustment up or down. Middle distillate had that bounce that we were talking about, residual, this small movements, essentially matching up with this just pretty steady 50.5. Realistically, we're going to be in this 50 to 51 million, which is that upper band level, with light distillate having a small draw, which then will reverse. Now, in our insights today, we talk a little bit about how gasoline is shifting, what are some of the shifts that are happening. And then when we look at Europe, you can see that there was a decent build in gasoline, as a lot of those flows have now stopped going from Europe into the U.S. We've actually had 3 tankers that were flagging New York Harbor shifting south. So that's just going to prolong some of our imports of gasoline. It'll bring down this week, but it'll just expand how we're going to stay elevated, just because it's going to take longer to move. And then when we look at some of the draws in the heavier products like gas oil and fuel oil, fuel oil was only small, still at the upper band, but gas oil, there was a slowdown in some of the June imports that has now accelerated for July, with 3 VLCCs targeting Europe. So that's going to be something that's going to adjust as well. And then when we just talk about briefly, China is now at 84 tankers flagging. That is up about 4. So we did see a little bit of recovery. That's at a 3-week high. And when we look at wet crude is at a still seasonally adjusted all-time high storage and Shandong, and fuel oil, same thing. So now when we turn to OPEC, now if you remember back in December, and I know it was a long time ago, we had said that the UAE was going to become the bigger problem. Because remember, they cheated, and then Saudi called them out for cheating. And the UAE was always annoyed because they thought the baseline of that 3.1 million was too low. Because if you remember what was happening, Russia and Saudi Arabia were running oil production higher. They were going at this essentially market share war, and the UAE never really did. So when they decided to strike the baseline, the UAE was actually at a disadvantage when you start factoring in those cuts. So what happens? The UAE has said, look, we shouldn't be at 3.1 million in baseline. It should be at 3.8. So this would take up or increase the amount that they're allowed to produce by about 600 to 700,000 barrels. So you can see when we look at this level that was expected. Now, this is what Bloomberg had calculated, which is in line with, I think, what the expectations were. They had initially said, look, we're going to increase production by 400,000 barrels, and then we're going to increase 2 million between August and December. Now, that has been called into question. This is not official. They keep going back and forth because the UAE wants to increase the baseline, so they're not agreeing to this. And now the UAE and Mexico are saying that they want the deal to end in April of 2022, when it was initially supposed to end. Some of the agreements were to extend the deal from April 2022 to December 2022. Now you have Mexico and the UAE saying, look, we still want an April 22 expiration, and UAE still wants their baseline increase. Now, there's most likely going to be some sort of agreement where Saudi Arabia and Russia will agree to let UAE go from 3.1 to maybe 3.4, and Saudi will slow bringing back some of that excess capacity and allow the UAE to bring it back instead. Now, these are some of those pushbacks that we're looking at and looking for. Unfortunately, there hasn't been a decision, so this could very well change as we go into next week. So then when we look at what are the exports doing, because it's always important to appreciate exports. So if you remember, the UAE was supposed to be exporting 2.7 million barrels in July. So that's slightly above where they were supposed to be in June. But when we look at what they've exported in June, it was actually 2.85 million a day, 445,000 above. So when you look at some of those adjustments, when we look at UAE, when we look at Iraq, so Iraq actually went down because they didn't have buyers for their crude. I know, but the physical market is tight. So they actually had a decline because India and China did not buy on that level. And you're starting to see why. Well, let's look at the UAE. So the UAE is sitting there and they have 445,000 additional 1,000 barrels a day in the market. Then all of a sudden it's like, oh, is that why Dubai was cheaper than Brent, WTI, this excess? And remember, they have the Murbain futures contract, which settles in physical, and it doesn't have a destination clause. So that just means that anybody can buy it. Typically, Saudi Arabia has it where if China buys it, it has to go from Saudi Arabia to that port. And instead of without a destination clause, just means that Exxon can buy UAE, barrels, and then they can resell it to Total, and then Total can sell it to Statoil, and Statoil can sell it to CNOC. And it can just move anywhere that it wants or to the highest bidder. So this just shows where some of those increases have been. When you look at the net number, the total, you can see that it's up about 700,000 barrels a day of what actually hit the water. And it's also important to understand that right now, the Middle East uses a lot of this excess in order to generate their electricity. So as we come out of summer season, whatever, the excess crude is going to get put back into the market as exports because they won't need it as much. This will slate more to go into the global market. So a lot was made on the Libya increasing OSPs, and I just wanted to put into context where their OSPs are in relation to previous years. So you can see that we're actually below the 2020 OSP level. And again, this is just that starting point. It's still an increase, but you can see that there's normally an increase as we go into this peak season. All the while, Trafi offered 100,000 tons of Urals for July at 230 below dated Brent. It initially was at 2. Gunvor at 220 minus Brent, and then Latasco at Urals of negative 250, all of which keep getting moved lower. Now, Angola did have a offer out there for $1.30 above Brent, but right now that hasn't crossed. We're seeing some of these offers get put out there just to see if there's a taker, but so far that there hasn't really been all that much. It's been, putting it out there and then slowly walking it back to see where those buyers will come in. And now when we look at China, when we look at India, we can see that they're buyers, but they're not aggressive buyers. They're just buying a kind of a normal amount, even though India missed a full month. So those are some of the things to consider. And then this is looking at what is going into more specifically Europe. And then on the other side, when we look at SHAAR, you can see that we're actually at a seasonally adjusted right near the all-time low. It's actually the lowest from 2017. So yes, it did increase, but it normally increases. And that's why we always talk about seasonality. What does seasonality mean? And this is when we start looking at crude prices, WTI sitting at $75. Gasoline prices are through the roof, and not just gasoline, but also diesel. And that comes back to inflation. What does that mean for the consumer? What does that mean for pricing overall, just based on that underlying cost, which gets us to the jobs number. So now when we look at the jobs number, June payroll came in stronger than expected at 850,000 versus 720,000 estimate. And then the prior month was revised up from 559 to 583,000. So now we are only 6.76 million below the pre-pandemic level. So still making progress, but we have to now look at where are we making progress? Who is getting hired back and at what price? Because the price is going to dictate what is cost, how much our price is going to get pushed up. Because not only do we have labor issues, within the oil patch, but there's also labor issues throughout the, other industries. So just to put it into context, you can see that we have that steady trend up. But remember, the pre-COVID path is already moving at an upward trajectory. So we need to see a little bit more of an acceleration, and it's likely we'll get one either in the end of August or September when some of the other excessive benefits start to expire and people need to come back. But we're also seeing PMI slow, where when we look at the manufacturing PMI, employment is actually in a contractionary period right now. And this is looking at it for what's to come, which is, again, some of the underlying problems when we talk about where employment is going to be, because we've seen more furloughs, disruptions because of lack of ability to get some additional equipment. So then when we look at contributions to the headline payroll, you can see that, again, the biggest one was driven by leisure and hospitality. So to be fair, the biggest additions were restaurants and teachers. So when we look at where things are, and you can see state and local and this leisure and hospitality. So there's only so much that we can get in terms of leisure and hospitality. And remember, they're also some of the lowest paid. So yes, it's good in terms of them coming back, but they're also at the lower end of that scale. So when you think about consumer purchasing, what is that power really going to look like? And it's important to say, well, at what rate are they coming back to? And this is where you can look at the average wages in bar and restaurant, where it was typically at about $13.50 in May, and now they're at about $15.50. Now remember, this is straight pass through. So this is going to get loaded into your burger, your fries, your beer, because they have to pass on this cost. It's not only just the oil that they use to make the French fries or the buns to make the burger, but wages. This is another key component, and that's why we continue to see this push higher. And just let's be fair, this is why companies are also saying, look, let's just have an employee work an extra few hours instead of hiring a whole new person, because they're going to have to come in at a higher wage in order to compete in the market, but also to compete against some of the unemployment benefits. All the while, there was an increase in the number of individuals unemployed for greater than 27 weeks. It's still not back to the peak, but it started to slow down a bit, which is a little concerning. And then on the other side, because there was actually an increase in the unemployment rate, and typically that happens when people start coming back into the workforce and the labor force participation rate increases. So there was no change in the labor force participation rate at 61.6%. So that's where some of that unemployment rate, remember, people are quitting more, so there could be some temporary unemployment. So maybe the participation rate didn't increase. Instead, it was more on the quitting side, which is then factored into the unemployment, because it was only up small, not a huge concern yet. But the bigger concern going forward is ISM Manufacturing and unemployment, which we talked about, actually going negative or into contractionary mode because it's below 50. And remember, in yesterday's Econ show, we were showing how across on the regional Fed side, we were seeing some of these net slowdowns, which is just going to lead to what is employment going to look like, what is spending going to look like, and that's where some of these headwinds, and it's a mixture of, we just can't hire you right now, and that's where you're starting to get some of the slowdowns on hiring, but it's also those furloughs because of the supply chain. So this is one of those pressure points, but when we look at inflationary sides, wages and salaries in the private industry are up across the board. So that typically when you look at the pull up of that median CPI, you can see where the trend is going to take us. So then when we look at ISM Manufacturing, just to drive it home again, this is that breakdown where you've had this kind of normalization, if you will, on the underlying PMI number, but there's some things that are making up that number that are actually a net negative. Because when we look at prices paid, they're up to 92.1, the highest since 1979. Production up and strength in new export orders as well, but new orders fell, but still expanding because, again, there's that backlog, and unemployment was back in that 49.9 contractionary level. But it's not just the U.S. It's also when we look into Southeast Asia, you can see that there's actually contraction again. And now this is a mixture of multiple things. One, There was a strong start to the year. There was a strong start to Q2, and especially when we look at exports, imports. But now, again, that COVID variant has caused additional lockdowns. That's being factored in here. We saw some of those issues throughout Malaysia, Indonesia, Thailand, and then most recently, obviously, in India. So here's some of those problems in general. But the new order decline, it's because companies are still waiting for the stuff that they previously ordered. So why are you going to order new if you're just struggling to work with what you have? Now, this will start to pick back up, but it's going to take some time as we see some of this confidence continue to dip. Now, when we think about this dip and these problems, because we in this recent insights, we talked about 3 specific countries, and we're going to do a deeper dive next week when we look at what are the PMI breakdowns and how is that factoring into consumer confidence, because as we said in yesterday's econ show, the consumer confidence in India is at an all-time low. Now, it'll start to get better, but it's just the inflation side of these countries continue to ramp up. Angola is fighting about a double-digit inflation. The Angolan central bank increased rates to 20%. So we're starting to see some of these friction points because their underlying problem remains inflation. Now, when we turn to India and China, I think it's just because we did a deep dive on the geopolitics and we wanted to keep it a little bit shorter because that segment was also going fairly long. First, let's start with China. So China has moved troops to the border. India detected that the People's Liberation Army recently moved additional forces from Tibet to the Xinjiang Military Command, which is part of that Himalaya component through Ladakh. China is adding fresh runway buildings, bomb-proof bunkers to house fighter jets, and new airfields along the disputed borders. As we've been showing, there's been helipads, there's been additional runways built. So again, these are some of those issues that we've seen. And then Beijing has also added long-range artillery, tanks, rocket regiments, and twin-engine fighters. So what is the response? And this is, again, just to reiterate the border tensions when we look at where do China and India see the different capabilities, where are some of those troops? Because when you look at the issues, so it's Sikkim, when you look at Sukna, the extra troops there. And then when you look in Bhutan, because remember, the Doklam Plateau is a very important spot for moving through. So when we look at Sikkim or that Sukna, if you go straight south, you go right into the Bay of Bengal, and the same with Tezpur, which is essentially a straight shot up to the Doklam Plateau. If you go straight through, you either cut through Bangladesh or just miss it, but you go right to the Bay of Bengal. And if you remember to the right, this piece that is India, look at that choke point right there between Nepal, Bhutan, Bangladesh, and India. That is a choke point, and that to the right is a lot of farmland for India. And remember, Bangladesh has a fairly large fertilizer group, and Bangladesh is within the Belt and Road Initiative. So this is why the right area of this chart is so important. But now when we look to the left, when you look at what has happened so far, the disputed areas in Ladakh continue to be a pressure point, and that's where we continue to see not only just Chinese, but now Indian troops moving through. So India has redirected at least 50,000 additional troops to its border with China in a historic shift, and you can see it's not just in the north along the Ladakh side, but it's also in some of these key areas across the west side of the country, the east side of the country. So although the two countries battled in the Himalayas in 1962, India's focus has really been on the Pakistan side. And remember, there was a recent drone bombing on a Indian Air Force base, which it caused minimal damage, but again caused a little bit of really a big reason to move fighters and to reinforce this region. So yet when we look at it, the deadliest India-China fighting in decades, which we said was going to happen last year, it ended up happening 2 weeks after we thought it was likely. Over the past few months, India has moved troops and fighter jet squadrons to 3 distinct areas along its border with China, according to 4 people that are involved with military. All in all, India now has roughly 200,000 troops focused on the border which is an increase of more than 40% from last year. So remember, they were trying to step back some of these friction points, but we've actually seen an acceleration of the amount of individuals in that area, which is again trying to counter some of the movements that we've seen. So the reason why we talk about this is not to say that anything's going to happen right now, but as you move individuals, they are all human. And some people may get concerned and have an itchy trigger finger, because remember, previously they were unarmed patrols, and now that has since fallen apart. They've tried to put that back in, but so far, it's unclear who's adhering to it. Let's put it that way. So when you start increasing the amount of people there, then this is where it takes something small. Like if we remember in Japan, when Japan was in China, in the Marco Bridge incident, a Japanese soldier went to go to the bathroom. He was unaccounted for at roll call, and the Japanese turned around and said that the Chinese village was responsible for his kidnapping. He rejoined. They invaded the village to find him who was missing, because again, it's just an excuse, and it's just a means, because the powder keg has been set, and as you see these areas of friction increasing, there's just a greater chance of something going wrong. So these are some of the things that we always like to talk about and highlight as potential problem points. So if you have any questions, please let us know. We always love the back and forth. We always try to cover a decent amount of information and things that are relevant, not only just for the energy and oil industry, but also when we're looking at the global macro and geopolitical backdrop, because for us, they're all very interconnected, if you will. So hopefully everyone has some exciting plans for the 4th of July weekend. We hope you have a happy and healthy 4th of July. Enjoy the extended time with family. And thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.